welcome back. You're watching All About Stocks. Thanks for staying with us. G. Chokalingam is still with us and he's picked two stocks that we should be investing in. The first of the two stocks is his growth pick and this one is EID Parry. Here's an introduction into what that company does if you are not familiar with it.
EID Parry is one of the leading sugar companies in South India. The company has been around for over 200 years and in 1981 it became the member of the Murugappa Group. EID has a fully integrated business model and utilizes the byproducts produced in the sugar making process. This helps the company withstand pressure on profitability when sugar season ends. 90% of EID's revenues come from the sugar business, but the non-sugar business is just as robust. The nutraceuticals business accounts for 3% of the revenues, and the company's acquisition of Florida-based research firm Valensa is expected to boost its output further. But currently, with the company's dependence on sugar, it faces the risk of being a seasonal business, which will hurt earnings in the off-period. Also, the sugar sector is highly regulated by the government and is a politically sensitive industry. A single unfavorable government policy could hurt the stock and the sentiment surrounding it.
Alright, so that's the first recommendation, EID Parry. Mr. Chokalingam, the diversity of the business is very interesting here. This is a company that does a lot more than just produce sugar. Is that something that excites you about this stock?
Yeah, definitely. It's a very interesting play on agri-team because it holds about 62% stake in Coromandel International, which is into fertilizer. And it is, according to me, Coromandel is the most efficient fertilizer producer. So you can better play through EID because Coromandel has run up in the last 3 years. And if you look at the enterprise value of EID Parry, which is 1,000 crore less than its investment value in Coromandel International. And the remaining businesses are not at all captured by the current valuations. So apart from Coromandel International business, it also has 19,000 TCD sugar capacity and 84 megawatt of power. And also it has acquired 2 more sugar businesses in South. And apart from these capacities and investments, it also has 100% subsidiary which is known as a Parry Infra, which has set up a food processing special economic zone in Kakinada. So, and also the company is the most efficient producer of sugar in South. And recently, there is an estimate that in Tamil Nadu, the sugarcane production would be 20% more than the last year. And that would be very favorable to this company because it makes a lot of power from, cane crushing.
As retail investors, we are constantly told to stay away from sectors that are dependent on government policy. And we know that the government has a policy as far as exports of sugar are concerned. And every time that tweaks a little bit, it impacts the stock. How much do you think, government policy impacts the sugar business, especially for this company?
Definitely. The impact is substantial because it impacts in terms of, the levy quota, free sale quota on month the government releases. And also the policy on export of sugar, and also the cane price. That's the most important concern. That's governed by both the central government and the state government. But the fact is that EID Parry is the most efficient, and in my memory I can tell you that when sugar price crashed to even 10 rupee 80 paisa per kg, EID Parry declared a dividend. That's because the way they manage their debt as well as the sugar plant, amazing. And they are certain to remain as the most efficient, and they would continue to make, produce the sugar at the lowest cost. And let me tell you that if you want to play on sugar, you have to be a smart investor. You can't wait for the cycle to turn around because always stock market cycle turns around much before the sugar industry turns around. So putting all these facts together, and also considering the fact that this year the sugar production is expected to be marginally up, and also considering the developments in the countries like the Brazil where the cane output is expected to dip by 10% in the main cane growing areas, I would play on this stock. And to mitigate the risk arising from sugar business, you have comfort in terms of tremendous investment in Coromandel fertilizer business.
Alright, a play on agriculture here, EID Parry, that's the first recommendation. But for retail investors who buy it, what's your target on this stock? Where do you expect it to move maybe in the next 2 or 3 years?
In 6 months to 1 year, the stock can move anywhere close to $300. It's already moved to 270 about a couple of months back, and then it has come down after this recent meltdown in the stock market. I'm expecting, around 300 rupees price within 6 months to maximum 1 year.
Alright, so that was the first recommendation, EID Parry. That's the stock we talked about. There's another one coming up, and this is the value pick for the long term. Bharat Electronics is the stocks that Mr. Chockalingam has picked for us. Take a look at his introduction on BEL and we'll come back and talk about it.
Bharat Electronics, or BEL, was established in 1954 by the Government of India to cater to the special electronic needs of the Indian Defence Services. The company makes night vision and communication devices for all three arms of the Defence Services. In the wake of the 26/11 terrorist attacks on Mumbai, BEL was commissioned by the government to develop radar devices to monitor coastal activities. BEL now is also trying to expand its non-defence business. The company recently designed a solar-powered tablet PC which will be priced at 3,000 rupees. The government plans to use this to boost education in rural areas. The company has seen a slight contraction in earnings due to higher employee costs. And as the government opens up the defence sector to private players, BEL also faces the possibility of intense competition. But a strong order book and cash balance has ensured that market watchers continue to be positive on the stock.
Well, BEL is obviously the leading defence sector company, but it's seen lower margins this year. There's a higher employee cost. We know that it's hiked its wages for its employees. Its order book has not grown as smartly. Do you expect it to continue maintaining its margins in the next year as well?
Yeah, definitely. In fact, the first quarter margin was down, but after that the stock has corrected. But the fact is that, historically this company always had a very low margin in the Q1. In fact, as per the historical standard, this particular Q1 margin is actually better than what it used to show in the past. Now, as far as the company is concerned, it's a cash-rich company. It's sitting on 6,400 crore cash on books as of March 31st, 2011. And the cash is about 55% of its market cap, and it's a zero-debt company. And its order on hand is around 23,600 crore as on March 31st. And the management has already guided that it could exceed 26,000 crore. And it's a very safe bet for retail investors. And also there is a possibility of significant upside due to possible special dividend. The government non-tax revenue is expected to come down by 53% in the current fiscal, and plus the divestment is not happening. So therefore, the logical outcome is that the government has to declare some special dividend to mitigate the concerns arising from fiscal deficit.
You said, of course, that it's a very cash-rich company. It's sitting on a lot of cash on its books. How does that affect its return on capital? Will that bring that down? How will it affect the final way, the view of the stock?
Return on capital, yes, it would be subdued because it's deploying a lot of its cash, for short-term lending. But as I said, next year there could be spurt in its return on capital employed because most of these orders which it captured recently, they would be implemented in next fiscal. So there would be substantial jump in the return on capital employed in 13.
The estimated PE multiple right now is about nearly close to 13%. Would you say that's a good point for retail investors to get in? How long would you expect an investor to hold on to the stock for?
Definitely, we are estimating close to 138, 139 rupee EPS for next year. And the stock should give a return of at least 33% minimum in next 1 year. And I have chosen this stock for retail investors considering the fact that there are a lot of volatility in the Western economies, and therefore a lot of volatility in our stock market. So this kind of stock can give a lot of protection on downside. At the same time, the stock drives strength from the domestic demand, which has to grow continuously because the defense outlays are growing anywhere from 12 to 15%. So the downside is very much limited, but upside could be minimum 33% in a year's time in a normal market condition.
We're expecting 33% in a year's time for BEL. Remember, these are the two stocks we talked about, EID Parry and BEL. Both of those stocks, as Mr. Chockalingam was telling us, dependent on domestic consumption, on the agri-theme, that's first stock, which is why he's picked it for us, because then we're not so dependent on what's happening in the global markets given the turmoil that we've seen over the last couple of months. Quick break again. On the other side, we're going to answer some of your questions that have come in for the week. We will talk about L&T in particular, so don't go anywhere.